Good evening, Patriots. This is Ryan Samuels. This is the Ryan Samuels Show. And tonight we are going to talk about Silicon Valley Bank and the banking crisis that is unfortunately upon us. Now, I have been discussing this for quite some time. Since the pandemic, I have been talking about the economic consequences of the political actions that we're taking in sheer panic and, quite frankly, non-necessity. Now, one of the main things that happened during the pandemic is the federal government issued stimulus checks. Now, in order to issue a stimulus check, the Federal Reserve has to print more money. Now, more money into the system creates a significant devaluing of the money that is currently in the system. This is called inflation. So a prime example of this would be De Beers Diamond Company. Now, De Beers Diamond Company, diamonds are expensive, and they're expensive for one reason, and that's because they are rare. When they are no longer rare, they lose value. They're no longer desirable. Anybody can have them. A rock in your yard is not valuable. A cup of sand is not valuable because they're everywhere. Certain rocks are extremely valuable because they're rare, like diamonds. So, the reason that diamonds are rare is not because they actually are rare. They're rare because they're only distributed into the system at very small quantities. That's why the De Beers company has billions and billions of little diamonds sitting in safes. However, if they were to release all of them into the monetary system or into the market, it would they would not be worth as much as they are, right? So that's a little supply and demand. Now, the same thing works for money or the dollar. When the American financial system has a certain amount of money in it, the value of the dollar is high, right? The more money you put into the system, the less the less that the dollar is worth. Now, the notion that inflation is corporate price gouging or inflation is the big business's fault, it's greed, it's price gouging, it's all nonsense, right? It's a logical fallacy that makes absolutely zero sense that people actually believe. This will tell you the IQ of our politicians nowadays. So the reason that Silicon Valley Bank failed is for one reason and one reason only, and that is that they were the victim of inflation. Well, two reasons. They were the victim of inflation, also bad policy by taking equity and diversity above risk management, and we'll get to that in a second. But back to how the dollar works. So in 1971, Richard Nixon took us off of the gold standard. Now, what the gold standard meant is you could only print as much United States currency for as however many coins were in, for however, you could only print what we had in silver and gold in our stockpile. You were restricted from printing any more of that. Federal governments don't like that. They want control of the money. They want to print as much money as they desire. So we were taken off of the gold standard, and now our coins have no precious metals, and our dollars are no longer certificates for silver or gold that you can turn into a bank at any point that you wanted to receive silver or gold. Now, silver or gold is important because there's a very limited supply of it. You cannot print more silver and gold. You cannot create more silver or gold. That's why it's actual money. What we have as the U.S. dollar is currency. Even says on it, United States currency, not money. Very important. So another piece I'll tell you is that the value of a product essentially never changes over time. You may think gasoline goes up and gasoline goes down, but I'm here to tell you that it doesn't. Gasoline stays at the same value for hundreds of years. Now, 100 years ago in 1923, a gallon of gas would cost you 25 cents. So there's one difference between a quarter today and a quarter 100 years ago. And that was that a quarter in 1923 was 90% silver. So if you had a quarter from 1923 that is 90% silver, and you wanted to sell it for its weight in silver, it would be worth roughly what a gallon of gas is today. However, we have more quarters in the system now than we did back in 1923, and they no longer have silver in them. So the value of that has significantly dropped, the value of the currency, not the value of the gasoline itself. Very interesting, right? But there's more. So during the pandemic, we decided to print more and more and more and more money and give it out to people, right? And the majority of Americans have less than $1,000 in their savings account. So when we give them this money, what do? They spend it. They buy new cars. They pay down credit cards sometimes. They buy new toys. They buy things that they want to do. They were stuck at home. They bought new televisions. They went on a spending spree. So stimulus checks stimulate the economy. They push the economy to its peak because everybody's getting all this extra money. Now, what that does is that there's so much money in the system, it drives up prices, hence inflation. So Silicon Valley Bank, during this time, received more deposits than they ever had in their history. Quadruple what they had done a year or two before. So what did they do with all this excess money? Well, Silicon Valley Bank did not have a risk manager at the time, although they had an equity and inclusion expert who hired people of multiple races and diversities and qualifications, which is fine. However, when you take precedence of that over a risk manager, it puts your whole company at risk. So there's one way that the Federal Reserve and the federal government can slow down inflation, and that is to raise interest rates, which is exactly what they have done. So they raise interest rates in order to get people to stop spending all of this money, and then they collect it through the interest rates, and then they burn it and get it out of the system. So the raising of interest rates can benefit the consumer, or they can hurt the consumer. Now, what the interest rates have done is, now cars, interest rates are higher. Mortgages, interest rates are higher. That's what hurts you. But what helps you is the interest rates in your savings account, or the interest rates in your treasury bonds, which is where Silicon Valley Bank made a drastic mistake. So with all this excess money, they said, we need to invest this, right? We don't keep money in the banks. Don't keep money in the banks. They spread it out. They buy houses with it. They do car loans with it. They pay the dealer. They pay the mortgage. They are the mortgage company, but they pay the builder. They pay the seller of the house. That's what they do with loans, and they have all these assets out there, so they very rarely have that much money on hand. But when Silicon Valley Bank received all these additional deposits, what they had done was they bought treasury bonds, which in theory is a phenomenal idea. However, in the current economic climate where we were printing more money than we ever have in the history of America, we can predict that the Federal Reserve is going to raise interest rates. So when you buy a treasury bond, say at 4% interest, and the Federal Reserve raises interest rates, and now there's treasury bonds out there with a 7% return on your bond if you purchase it, what are people going to do? They're going to buy the higher rate bonds. They're not going to buy the lower rate bond, and if they do, they're going to buy it at a significantly discounted price, which is what SVB did not account for. So the bonds that they purchased with all this extra money were worth significantly less, approximately $1.8 billion in loss just in treasury bonds. Now remember, the bank doesn't have any money on hand typically. So what we saw was a very unique situation that happened back in 1923, during the Great Depression. We saw a run on the banks. Now, the run on the banks is what caused the Great Depression. It was not the stock market crash itself that caused the Great Depression. It was the run on the banks. Everybody went to the banks. Everybody wanted their money. Banks didn't have the money. So what happened with the banks? It shut down. And that's what happened in this case. Everybody run into Silicon Valley Bank, said, I want my money. Where is my money? And they did not have it, so they had to sell their treasury bonds at a significant loss till they were in such a financial crisis that federal regulators had to come in and shut down the bank. Now, here's the thing, is that if you have up to $250,000 in your bank account, you are what is called insured by the FDIC, where they will give you your money back. However, Silicon Valley Bank had companies such as Etsy, that have significantly more than $250,000 in their bank account. So that's what they're only insured up to. So what do? Pulling it out, getting out of it. And then word starts to spread, and that's a panic, and it's a run on the banks. So they stepped in to shut it down, shut the bank down, and take over to make sure that there was not a run on the banks across the country, which would be the end of our economy as we know it. It is the scariest thing that happened in an economy. If you remember during COVID, when you went to your ATM, they restricted you to withdrawing up to $1,000 because they were trying to prevent a run on the banks. They were trying to prevent a panic that would cause a depression. I stated many times since 2020 that we are headed towards a recession. Anytime the Federal Reserve prints all that money, raises interest rates, we're headed towards a recession. Depression is significantly more horrific and is still a possibility. However, the Federal Reserve is going to take drastic measures to make sure that it never goes there. This is not the only bank that has failed currently. The politicians are not coming out and admitting this. The politicians are pretending that everything's okay, and this is what they did in 2008. Alan Greenspan got on a microphone and said that the world was secure in American mortgage loans. American mortgage loans were safe, although the subprime lending scandal was the biggest factor in the 2008 economic crash and the big bank bailouts. Now, what we're going to see here is going to be different. It's going to be very interesting. Theoretically, the federal government has already stepped in and saved everybody from COVID. Small businesses got interest-free loans, big checks, payroll checks, unemployment. They've already bailed everybody out before it was an actual crisis. So now we're in an actual crisis, and further printing of money, further bailouts, further stimulus checks are going to drive us deeper and deeper into this hole. And unfortunately, the only way out of this is to bear down and grit through it and allow nature to take its course. A natural economy, that is. So I hope that helps you understand the situation with Silicon Valley Bank and the crisis. I want to thank you for tuning in. This is Ryan Samuels. This is the Ryan Samuels Show. Do not forget to like, share, and subscribe. Don't forget to download my podcast on Apple, Spotify, Buzzsprout. We are everywhere. Thank you very much for tuning in. Also, you can get shirts like this and cool apparel at ryanfsamuels.com/shop. Thank you very much for tuning in.